You know all the strong jobs data and great economic readings that we've been getting over the last few months? Yeah, well, those aged like milk.
Let's dig further into both tariffs and, of course, this jobs number. Joining us is Goldman Sachs' chief economist, Jan Hatzius. Good to have you here on Jobs Friday always, but in particular, give me your reaction not just to the number for July, but the revisions, of course, which we've been focused on.
Yeah, I think it's the revisions, the July payroll number, and also the household survey, which also shows quite a bit of softness. So a couple of weeks ago, we wrote a report with the title Stall Speed. You know, we had only a little more than 1% growth in GDP in the first half. And with this jobs number.
And he said 1% growth for the GDP in the first half, and that's including the fact that the first quarter GDP was actually negative, and the second quarter slightly made up for it, bringing the whole half positive. But it is worth noting it was negative and then positive, so it's not all good news there.
I think that brings the picture to a more, clearly sort of stall speed.
But look at this. July jobs report key highlights. Non-farm payroll, 73,000 versus 100,000 estimate. That's 73% of what you thought you were going to get. If you're in school, that's basically almost a failing grade. Unemployment rate, 4.2% versus 4.2 estimate. All that means is that people estimated it was going to go up by 0.1%, and that it did. That doesn't mean it's good. It just means that we knew that it was coming. And then the average hourly earnings are up by 0.3%, which is pretty good. We saw them dip last month, or the fact that they're back up this month on a national average is good to see.
Image. I'm looking at an economy that is still growing, but it's growing very slowly, and the unemployment rate is drifting higher gradually. But I do think that the downside risks in the labor market, which Chair Powell did talk about in the press conference on Wednesday, that those are definitely there.
He talked about it not as much as he talked about the upside risk to inflation.
Well, he mentioned it, I think, 6 times that there are downside risks in the labor market.
And how many times did he mention upside risks to inflation? Probably more than that, no?
He talked about, the difficulty of making decisions when you are faced with this kind of shock, which raises inflation. And
there's also a difficulty in making decisions when the data that you're given is so astronomically off that you can't possibly be expected to make good and accurate choices. It was revised down for May and June by like 258,000 jobs. I mean, that's kind of crazy. That's basically all of the job growth that had been reported essentially wiped out in one go.
Lowers.
But does today's jobs report change the calculus?
Well, I think it makes it even more likely that they're going to cut in September. We have had a series of 25 basis point cuts in September, October, December, and to me that seems, very likely, and it could be more. I mean,
all right, let's look at this. Where the jobs are July's biggest jobs movers. Healthcare is increasing pretty significantly, 55,000 healthcare jobs added. And to be clear, it's good that healthcare jobs are being added, but that's not because things are going really well. It's because we as a country are getting sick more often, and we also have more and more old people that need to be taken care of. And so in order to keep up with the demand of an increasingly aging population, because our birth rate is dropping, we have to hire more people. Again, also the same thing with social assistance. This is helping people who are sick or old or unable to take care of themselves. And then we get down to 15,000 retail jobs added, and then 15,000 financial activities jobs added, with the stock market doing really well, which again does not impact the day-to-day lives of, the bottom 80% of Americans. The financial activities is probably just people being added at the high levels of a lot of big tech companies, AI, banking, etc., who are doing extraordinarily well. So again, this benefits the top percent. These benefit the elderly people. Retail trade is good to see, but then after that, there's kind of nothing else.
And it's certainly a reasonable idea that we're in the restrictive territory, but these sort of data suggest maybe we should get back to neutral a little bit more quickly. We have that happening over a longer period of time, but
we need to get back to neutral much, much faster than a little bit more quickly. I mean, it should happen as quickly as is humanly possible. Where the jobs aren't, July's biggest job laggers. Lagging is just another word for losses, where jobs did not happen. Utilities lost 100 jobs. Info, not exactly sure what that means, lost 2,000. Mining and logging lost jobs. Wholesale trade lost jobs. And the government lost jobs. And what's not on here is actually manufacturing lost 11,000 jobs. And that's one of the big stories that I think should come out of this. Well, second biggest story. Biggest should be our jobs data was just so terrible. And even the BLS, when they put out the report, they said that the revisions down were bigger than normal. Like, yeah, I should imagine they're being revised down to a fraction of what they were before. So of course it was going to be a bigger downward revision than normal. But additionally, the manufacturing data came out and it's absolutely horrendous. Here's a chart from CNN where there was a mass rehiring after the pandemic and then it increased for a little bit, and around 2022 it peaked. And since 2022, manufacturing hiring has fallen to about half of where it was. It's terrible. You can see here, factory hiring plunged in May below even the COVID-19 pandemic pace to the weakest rate since 2016 under President Barack Obama, according to the Bureau of Labor Statistics. Manufactured jobs openings, a sign of what's to come, have plunged by nearly 100,000 since Trump took office. We are not having a manufacturing revival in the United States like we had been promised. We're seeing jobs disappear, people aren't getting hired, the economy getting worse, and soon we will be seeing the major consequences of that.
You could accelerate the process.
Fed Governor Waller writes this morning, taken together, the data imply the policy rate should be around neutral, which the median FOMC participant estimates is 3%. And he says not the 1.25 to 1.5 percentage points above that. Do you agree with that?
I think it's a very reasonable case, and he also talked about stall speed in that note, and I think that's the right way to look at it. Look, I think we'll obviously learn more. This is a meaningful data release, but it's one data release, and we'll want to see what the picture looks like over the next couple of months. But if we get confirmation that things have slowed as much in the labor market, then I would say, yeah, we should get back to neutral pretty quickly.
I'm generally one for going slowly and making sure that you don't break things. You know, the U.S. economy is huge and very difficult to manage, and there's so much data. It's extraordinarily complex. But I feel like in this specific instance, what we're seeing is that what was predicted to happen when we have tariffs and trade wars, you know, the economy slowing down, the job market slowing down, is actually happening. And now that we are seeing the job market slowing down and inflation picking back up, there's, I think, a very reasonable argument for us to have a rate cut in September. There might also even be a reasonable argument that a rate cut should have already happened, but it's hard to argue that specifically when all of the data that we were given was so wildly inaccurate that no good decisions could have been made.
It feels like the main debate inside the Fed and out is not whether tariffs will spark inflation. We know it's happening, you know, in certain goods, and it might increase further. The question is, should they look through it? Is it a one-off inflation increase, or is it something that they should adjust their policy to? And that's where it feels like the dissenters feel very differently than the Fed chair and the bulk of the Fed board. So
it's not a one-off inflation increase. We've seen inflation increase for 2 months in a row. We're now in the third month of inflation increasing from 2.4% up to 2.7% in June, where we are now. We'll probably get the July numbers here in a couple of weeks, but it's not correct to say it's a one-off. It's not a one-off. It's a pattern. It's a trend.
Which is it?
Well, the Fed chair did say that the baseline scenario was one in which this was a one-time price increase. Now, he noted risks to that, as you point out, but he did say that was the baseline scenario. That's clearly the wallet scenario.
If that's the case, then why didn't they cut?
Because it takes a while to persuade everybody that that's the right course of action. I mean, there was never a meaningful probability of a July cut. The discussion in the committee at large has always been about September. And so
that is true. There would have had to have been an absolutely horrendous amount of economic data to come out to see any kind of a July cut. Essentially, nobody thought that there was going to be. There was some suspicion that maybe Trump could pressure the Fed into doing it. But as the July cut came around, there were 10 people that voted not to cut and only 2 that voted to cut. And those 2 that voted to cut only were voting to cut it by 0.25%. There was never any way that we were going to get a July cut, especially not with data that was inaccurate.
Yeah, I think that's what we're looking at. And now September, yeah, it looks very, very likely.
Jan, your team has done a lot of work on AI. I periodically ask you about it. I was just asking Sarah, though. Do you think that there's anything showing up in the data already in terms of at least the change in hiring that may be taking place as a result of the efficiencies brought to bear by enterprises adopting AI?
Yeah, I do think we're seeing early signs of it. We're seeing, for example, some weakness in technology employment over the last couple of years. Actually, as it happens, it started right around late 2022 when ChatGPT was released. We've seen a decline in technology employment as a share of overall payrolls. We've seen some weakness in the unemployment rate for young tech workers. So it is happening. So far, this is not the main thing that's driving the labor market. We're still quite a ways away from that, but we're seeing early signs.
Yeah, we are seeing early signs of AI meaningfully taking away jobs, but I do agree with him that this is not the primary thing that's happening right now because AI hasn't reached a point where it's able to meaningfully replace enough people to really show up on any kind of a jobs report. That's probably going to happen. Give it 5 or 10 years, and we're definitely going to be contending with the ramifications of that decision. But as for pinning anything on AI right now, it's a bit too early to make that call.
The Fed does start to cut in September, as you predict, and we get, what, September 3 cuts this year is your prediction. I think the market's at 2. If we start to see that, is it in time to preserve what is otherwise a really healthy labor market and overall economy?
I hesitate with her framing that we're preserving an overall healthy economy and labor market. We're not. I don't think we're seeing enough signs of a healthy labor market. We saw 2 terrible, almost flat months of job growth. And then we've also seen inflation starting to pick back up. We've seen wages go up very, very slightly, essentially, an unmeasurable amount because of how small they are. So I'm not with her in claiming that the economy is doing well. And I don't think most people feel like the economy is working for them. So it's a loaded question because of how she's phrased it, as if the economy is good. Do you think that this is happening in spite of that? Not correct. The economy is not doing great right now.
I mean, our forecast is that the economy continues to expand. We have a 30% probability of a recession over the next 12 months. So that's twice as big as the unconditional average of 15%, one recession every 7 years, but it's well below 50%. So yeah, that's my baseline. But I would note that the economy is growing at about a percentage point below potential, and the labor market numbers are now confirming that. So I do think that we're going to need to see some insurance being taken out.
I don't think we're going to hit a recession purely because GDP only measures the entire economic activity at once. And as long as we're having companies like Google, OpenAI, Amazon, NVIDIA, Meta, and so on buying hundreds of millions of dollars worth of chips, we're not going to hit a recession because that economic activity is going to be tracked in the GDP. So as long as this AI boom is happening, and I put it in quotes because it's not actually making money yet, but people are spending a bunch of money on it, I don't imagine we're going to see any kind of a total nationwide pullback, but I do imagine that we're going to see unemployment, especially among lower income people or recent college graduates, spike more than it already is. So maybe not a technical recession, but insofar as the bottom 50% of the population is concerned, I think we are going to see economic pullback there.
Well, someone else is going to be handling that one way or another, it seems. Neil Dutta, what do you make of what we got in the data today, the best data that we have at the moment anyway, and what investors should really take away from it about the state of this economy and the market?
Well, I think for the Fed, it feels a little bit like deja vu all over again, because this is kind of where we were around the same time last year. Things sort of seem okay, and then you kind of get punched in the face with a weak jobs number. And, make no mistake, the jobs number was weak. It wasn't just about the revisions, which tend to be cyclical in nature historically, right? So in good economies, data tends to get revised up. In bad economies, data tends to get revised down.
And so probably what we're going to see is July's data revised down. I don't think anyone is believing the July numbers are as lofty as they seem, even though it was a bad miss already. I suspect come next month or the month after, whenever they choose to issue the revision, we're going to see that drop maybe by 10 or 20,000.
But I think what's important is that the prime age employment rate, so those aged 25 to 54, that employment rate is down about 0.5 percentage point against last year. That is not typical for a good economy. There's been a lot of kind of rationalization away of the jobs number. Well, it could be immigration and so forth. If you look at college unemployment rates, they're clearly going higher. I mean, so to me, like using immigration as a rationale to kind of wish cast away the jobs data, I think is a mistake. So, to me, the Fed is in a pickle, I think, because inflation numbers might get a little worse over the summer, but ultimately...
inflation numbers are almost assuredly going to get worse as more tariffs are dropped on everything, so expect those to go up as well. But he was talking about the college unemployment rate. That's especially bad because college students are like young, full of energy, generally don't have high salaries, but have high production and output for the economy. So we like those to be really high. We want everybody who is well educated, having a degree, and able to contribute meaningfully to society to have jobs and be able to actually do that. And the fact that they are trying really hard and unable to, which we actually covered in a video yesterday, you're welcome to go watch that, is a pretty big indicator that things are not going well. If you graduate from college, great education, bachelor's degree, ready to work hard, looking for a job, and you just can't find one, that's not a good indication that things are going really well.
For me, it's about the nominal anchor. And it's pretty clear that nominal incomes are slowing. And so I think Governor Waller, as an example, is on very, very solid ground. Ultimately, I don't think consumers really have the capacity to absorb higher prices. And as a result, I think the Fed's going to be cutting in September.
I think absolutely the Fed's going to be cutting in September. And he said that consumers do not have the capacity to absorb higher prices. And I think that is actually correct, because we're seeing a slowdown in people and how much they are purchasing after an initial wave of a bunch of companies importing new products to try and get ahead of the tariffs. And once those tariffs actually hit, I think we're going to see a massive slowdown of people actually purchasing stuff. Why? Well, everything's too expensive and wages simply are not really keeping up. However, if we get a cut in September, we might start to see that spending pick back up as money is cheaper to borrow and people are able to have more stuff with, like, their mortgage being lower and such.
Of course, it was interesting to get those statements from Waller and Bowman today on the heels of that data. Neil, I mean, just to put a finer point on it then, if you have a labor market that's weakening, and if it continues to weaken, doesn't that actually mean slower consumption, which in turn slows the economy and ultimately could slow the pace of price increases?
Well, we've already had slower consumption. I mean, that's the sort of nasty little secret. If you look at the first 6 months of this year, real personal consumption is actually down, okay?
And that's notably different from like company or wholesale consumption, because again, a lot of companies were importing massive amounts of stuff so that they wouldn't be as impacted by the tariffs. But personal consumption from people actually buying things saw a brief spike, but overall, especially relative to previous years where inflation had come down or wages had kept up pretty well, we are not seeing people buy and consume as much as they have been.
That's not widely known, but you have basically, I think, three economies, Morgan. You have housing, which I think is in recession. Single-family permits are down quite sharply. The consumer is, on very, very thin ice. Real spending is down. Even in services, by the way, it's weakening quite notably. You can't really shift that around because of tariffs. And then, on the final piece of it is this AI boom, which has been spectacular. But ultimately, I think broad CapEx outside of AI tech, that's going to be sluggish, because ultimately, if companies feel less good about the outlook, they tend to spend and invest less. So that's what I anticipate going forward.
And all the money from the AI tech boom is coming from one huge mega corporation that's worth trillions of dollars and just being transferred over to another huge mega corporation that's worth trillions of dollars. Essentially, it is, basically only NVIDIA that's making good chips. But NVIDIA is getting money from every other huge tech company that wants to be AI first. No actual people are seeing the result of those numbers. No human gets more money because a bunch of chips are manufactured. NVIDIA gets a huge amount of money from the purchase of the AI chips, and then Google, Amazon, Meta, and all of those big tech companies get huge investments from like really rich investors because they are seen to be AI first and will absolutely make money on AI one day. If you're not directly involved in the transaction of AI chips being sold to AI first companies, then you're not seeing any benefits from that. I think it's a reasonable question to say, okay, so we got these bad jobs reports, like what are we going to do next? And the answer is probably cuts, but cuts in September. However, we can't just cut willy-nilly, because there's a possibility that inflation, which has already been creeping up, is going to continue to creep up more or skyrocket. If you cut rates, then money is cheaper to borrow. If money is cheaper to borrow, people have more money. If people have more money, people spend more money, which is great. That helps the economy function better. However, if you have more money and people are spending more money, then companies will look at that and say, well, look how much money the average person has. They're spending more. We can raise prices because people are willing to pay more because they have more. And that results in inflation. The issue being that inflation has already been creeping up over the past couple of months. So how is the Fed going to react to this?
Report coming in weaker than expected. President Trump just posting on Truth Social, too little, too late. Jerome, too late Powell is a disaster. Drop the rate. The good news is the tariffs are bringing billions of dollars into the USA.
A couple of points here. He says too little too late. Powell dropped the rate. Probably we are looking at a September rate drop. The good news is that tariffs are bringing in billions of dollars to the USA. Tariffs are not bringing in billions of dollars to the USA. 80% of tariffs are being paid for by consumers themselves who are paying higher prices to those companies. Tariffs are a tax to the US government. Companies respond to taxes by raising their prices. Most of the 20% that the companies aren't paying, remember, consumers are paying 80%, then there's 20% being paid by other people, are being just absorbed by the companies. And it's only being absorbed by the companies because they're hoping there's a chance that Trump will back off of the tariffs like he has in the past with other tariffs. If these tariffs turn out to be permanent, I would not expect those absorptions to remain.
Clearly, the president thought that his tariffs were actually going to have this impact and therefore needed the Fed to make these moves. We're going to bring in Roger Ferguson right now, former Fed vice chairman, now a CNBC contributor. What do you make of all of this, Roger? What's your reaction?
All right, Roger. Time to cut. He's never
my
said
reaction.
it.
No, hold on, Joe. My reaction is that this creates increased complexity for the Fed, not simplifying the decision.
You don't say.
What we didn't focus on is average.
Look at everything going down. The 2-year Treasury is down, the 5-year Treasury is down, the 10-year Treasury is down, and the 30-year Treasury is down.
Early earnings going up from 3.7 to 3.9. It's a backdrop in which there are a number of analyses that suggest inflationary pressures are more likely to increase than decrease. And the other point to make is the unemployment rate, which is the one that Chair Powell focused on most recently, stayed roughly steady at 4.2. So increased weakness, the revisions are not helpful. But as he will tell you, as he did tell you, there's a lot of data left to come. So I think the market's pricing in a big move towards September. Maybe right when we get there, but I think it's a little too early based on one
Roger,
relatively weak report.
Roger, I could see. Look, if you really believed that that Powell was going to move in September, some people would actually look at this oddly as good news, because it would mean that he's going to move in September. Maybe he's going to move again in December. Right? The markets are not saying that right now. I think they're worried that he's not going to move to some degree.
I don't like to view this as good news because people who are trying to get jobs are unable to get jobs. I think that's basically always bad news. I would rather this not be happening at all.
Look, so I think the markets are right, because he was pretty clear with what we call a reaction function. As long as inflation is somewhat above the target, as it is, and the labor market looks fundamentally healthy, then, as he said, restrictive policy may well be right. If the balance of risk changes, they're worried less about inflation but much more about unemployment, then maybe it's time to move. The labor market has shown that it's roughly in balance. I agree this has elements of weakness here, but
Elements of weakness? We saw basically 2 full months of the labor market not changing. Like 106,000 jobs have been added in the last 3 months. That's the lowest since like the COVID pandemic. This is not signs of weakness. This is active collapse.
That 4.2 unemployment rate basically says supply and demand are roughly where we want them. And so I think the market's right to say, this is a bit of a head scratcher, not this is a clear, all the hands on one side, cutting aggressively in September. We may get there, much more data to come. I think it's premature to say this report is so unambiguously weak unto itself that the Fed has to pivot and be prepared to cut at all costs in September.
You never see a big jump in unemployment, do you, Roger? Do you remember in your experience, what's the biggest you see? I mean, you couldn't go 4.2 to 4.7 like in just like a matter of months, could you? Or is that, and we don't have a lot of time left, but is that possible? Something like that could happen?
Well, you said in a matter of months. Obviously, it's possible in a matter of months. It's a sign of an economy that's moving to recession. Does it move that way from report to report? No, it does not.
Okay.
But
I mean, it did during the pandemic.
we caution everybody, one report, let's wait and see. Right. That's what Chair Powell said. I think he really believes that. There's a lot more data to come.
Well, yeah, of course we are going to wait and see. We have to wait and see. Nobody's going to be able to cut rates before September when the next meeting is. So, I mean, all we can do until then is wait and see as the job market continues to get weaker and tariffs go up and inflation increases and stuff gets more expensive and people don't know what to do. Thanks for watching.